We are at the offices of Oaktree Capital Management, where I have the pleasure of speaking with Howard Marks, the chairman and co-founder of Oaktree and one of the world's greatest investors. Howard, thank you for joining us.
Thank you for your interest.
You have published a book with the title The Most Important Thing, which has received praise from Warren Buffett and, according to Joel Greenblatt, is destined to become an investment classic. Before we get into discussing some of the concepts in the book, tell us, what was your motivation for writing the book in the first place?
I've been writing memos to my clients for 22 years. I started in 1990, and I frankly can't remember what the initial motivation was. It's too long ago. I also can't remember what kept me going for the first 10 years, because for the first 10 years I wrote these memos, and I never had a response. I never had one response in 10 years. So as I say, I can't remember what kept me going, but something did. And then on the first day of 2000, I wrote one called bubble.com, which talked about the tech being a bubble, and turned out to be right soon thereafter. So as I say it, after 10 years, I became an overnight success, and have been publishing the memos continuously ever since. And I always thought that when I retired, I would pull it together into a book. And my retirement is some years off. But then I got a letter from Warren Buffett a couple of years ago, and he said, if you'll write a book, I'll give you a blurb for the jacket. And that was the deciding factor. And so I wrote it with, and I was also approached by Columbia about doing it. And those two factors convinced me to do it, basically to write it in 2010, and then it was published in 2011.
You start the first chapter with a rather inauspicious but profoundly true statement that few people have what it takes to be great investors. You go on to introduce the concept of second-level thinking. Help us understand what is that and how can it help us as investors?
Well, the interesting thing about investing is what I call the perversity. The point is that it is so not intuitive. It is so not obvious, investing. And a great example lies in the fact that people think that to be a good investor, you have to understand companies. But the market has an understanding of companies. And if you understand the company the same as the market does, even if the market and you are right, you're not going to make any special profits. The success, which is doing better than the market in a risk-return sense, comes from understanding things better than the market. Now, most people don't understand things better than the market, and most people don't understand the need for understanding things better than the market. So it really is, and as I say in that chapter, not only do I not want to try to simplify the process of investing, I want to show how not simple it is. And too many people try to simplify it. And I mentioned in that chapter the guy on the radio who says, well, you go into a store and you buy a product, and if you like it, buy the stock. That's so wrong, because that's, liking the product has either nothing to do with making a good investment, or it's just the very, very first step of many steps. So you really do have to think, as I say in that chapter, either, probably both, better than the average investor and at a higher level.
So how can we actually improve our chances of thinking different from the consensus while also being right? Is it what's the impact of nature versus nurture, if you will?
You have to understand that, first of all, that the consensus has an opinion. And you have to understand that the consensus is not a moron. So much of the time, the consensus is about right. Now, if to do better than the consensus, you have to think differently than the consensus, it means you have to find the times when the consensus is wrong. It doesn't mean that the consensus is always wrong, and just thinking differently is the key to success. So you have to find the times when the consensus is wrong, and then you have to think differently, but not just differently and better, because you could think differently and worse. So it's not just holding a non-consensus opinion. That's not the secret. It's holding a correct non-consensus opinion when the consensus is wrong, which is not all the time. And I think I mentioned in the book that when my son comes to me, who's a budding hedge fund investor, he gives me an idea, a stock, a macro trend, or something like that. The first question I always ask is the same. And who doesn't know that? That's really the question. When you think you know something, the question is whether the market knows it too. And if it does, then your idea has no relative superiority.
In an investment industry where lucrative careers can be built just based on consensus thinking, what types of work environments are conducive to develop one's second-level thinking abilities? How do you ensure you have such an environment at Oaktree?
I think that the people there have to be deep and stimulated and stimulating and interested in discussing. I try very hard to create an environment where one person's success doesn't have to come at the expense of another. In fact, everybody collectively can be more successful than they would have been separately. I think these things are very important. But, you have to start with smart people who are also wise or introspective. For example, I don't get the concept of trading to make money. And so I like to surround myself with other people who don't get the idea of trading to make money. And by the way, there are probably some people out there who trade to make money. I don't say my way is the only way, but it's the way for us.
You have applied second-level thinking to great success in inefficient markets, which have been a focus for Oaktree. What types of mispricings are your favorite hunting grounds, and have they changed over time?
34 years ago, when I started Citibank's high yield bond fund, it was easier because the investing world was much more narrow-minded at the time. And many, for example, pension funds or endowments had a rule: we won't invest in any bonds that are rated below investment grade, below BBB. So almost on the surface, if everybody says we won't do that, then that is probably going to be cheap. Now the world has changed in this time since, and now most people will do anything to make money. And of course, the world has filled up with hedge funds whose job it is to do everything. So it hasn't gotten easier, and arguably it's gotten harder. But on the other hand, not necessarily, because I think that our margin of superiority versus the high yield bond averages has remained about the same. And we think that the ability to make money in the stressed debt business has still exists. So I think there's this process that I call efficientization that in theory should happen, and hasn't really happened as fast as I thought it would. And I think it's all down to the foibles of people. People just many are people individually, and markets are ruled by emotion. And as long as emotion takes over, then efficiency will not be realized.
With the trend toward compression of time horizons in the investment industry, do you see a growing inefficiency in the pricing of longer duration securities, or securities that may lack a so-called catalyst?
It makes sense. When everybody thinks one way, then there should be a reward for thinking the other way. When I started off as an investor 43 years ago, we used to think about holding things for 5 years or 10 years. And now, 5 months would be a long time, and maybe it's 5 days or 5 weeks. On the one hand, there should be a return for thinking longer. On the other hand, a lot of people say that the long term is just a series of short terms. So I would say that's one of the things working on the side of the patient investor is the fact that he has a longer time frame. On the other hand, we don't explicitly, there's a new phrase, time arbitrage. We don't explicitly pursue time arbitrage, but we have patient capital, and we're patient people. In our distressed debt funds, for example, the money's locked up for up to 10 or 11 years. So we can be patient. And, again, if you're the only person in the world who's open to making investment X, then maybe it'll be available to you cheaply. And having patient capital is a great advantage, I think.
You state that an accurate estimate of intrinsic value is the indispensable starting point for investing to be reliably successful. But for you, that is not enough. One needs to hold a view strongly enough to be able to hang in and buy, even as the price declines suggest that you were wrong. How do you build such confidence in an uncertain world? And how do you walk this fine line between confidence and overconfidence? Did you have any mental models, any checklists that are helping you and Oaktree in navigating this?
I really think that the things in the book have been our models for the last, 17 years since we started the company, and longer, before when we were working together before starting the company. It's not an algorithm. It's a mindset. I think that we always try to stress the danger of overconfidence or hubris. I frankly forget if I put it in the book, but it's better if you kind of invest scared. If you worry about losing money, if you worry about being wrong, if you worry about being overconfident, because these are the things you want to avoid. They should be foremost in your mind. You should never, the most dangerous thing is to think you've got it figured out, or that you can't make a mistake, or that your estimates are right because they're yours. You have to always recheck your information, bounce your ideas off yourself and others. But on the other hand, it's really not a good business for people who don't have some ego, because you have to do the things that Dave Swensen describes as lonely and uncomfortable. As I think it was Everard who said that it's warmer in the crowd, in the herd, but if you only hold popular positions, you can't do better than average by definition. And I think you'll be very wrong at the extremes. You have to be strong enough in ego to hold difficult, unusual positions and stay with them. And so, as I say in the book, you have to have a view which is different from the consensus, and you have to be willing to stay with it, and you have to be right. If you you have a non-consensus position and you stay with it and you're wrong, that's how you lose the most money. I keep going back to what Charlie Munger said to me, which is that none of this is easy, and anybody who thinks it's easy is stupid. It's just not easy. It's just there are many layers to this, and you just have to think well. And I can't tell you how to think well. But it's some people get it, some people don't.
You devote 3 chapters of the book to the concept of risk, how to understand it, recognize it, and how to manage risk. You take particular issue with the traditional risk-return graph, which you say communicates the positive connection between risk and return, but fails to suggest the uncertainty involved. Tell us how your interpretation of the risk-return relationship helps you avoid the losers to achieve better performance.
Well, first of all, as you know from reading the book, we define risk primarily as losing money, the potential for losing money. And we don't want to lose money. Our clients don't want us to lose their money. They don't mind if we experience volatility. We have patient capital, which permits us to live through volatility. But they don't. In the end, they don't want to lose money. So, number one, we don't empathize with the view that risk is variability, that variability is the thing to be avoided, per se. Every once in a while, especially in good times, I hear people say the way to make more money is to take more risk. And that's ridiculous, in my opinion. I mean, taking more risk should not be one's goal. One's goal should be to make smart investments, even if they involve risk, but not because they involve risk. And that's a very important distinction. So the figure that I draw in the book, I think is called 5.2, shows that what risk means is a greater range of outcomes, some of which are negative. You have to bear in mind when you make investments the presence of the potential for the negative outcomes. You have to only make investments where you're rewarded for taking that risk and where you can withstand the risk. That requires diversification, patient capital, and eventually being right in your ideas.
There is another profoundly insightful chart on page 2 of the book, which shows how the risk-return graph is affected by historically low interest rates in the U.S. With 30-year treasuries priced to yield 3%, what investment implications do you draw from this?
It's very difficult. When 30-year treasuries yield 3%, that kind of sets the bar for everything else. Everything else trades off of that, which means not at very high returns. And that means we're in a low return environment. And one of the things I believe is that we must understand the environment we're in, understand the ramifications, and accept it in the sense of accept the reality and not think that, one of the hardest things is to make high returns in a low return world. And if you insist on doing so, you can get into trouble. If you say, well, treasuries used to be 6 and high yield bonds traded at 500 over, so I made 11 with ease on the average high yield bond. And so even though treasuries are now 3 or 2 on the 10-year, I still want 11. And I'm going to get my 11. Then you end up making investments that may be poised may appear poised to pay 11, but because you now need 900 over, you may take greater risks than you used to take to get the same return. So just insisting on making the same return that you used to make can be very dangerous. And Peter Bernstein once wrote me, and brilliantly, he said, or maybe he passed on a quote from Elroy Timpson, who said that the market is not an accommodating machine. It will not give you high returns just because you need them. And you have to realize that. So, if you say, look, I used to get 9, I used to get 11, I still need 11, so I'm going to take more risk, you can do that. But the key is to recognize that you have to take more risk to do it and to make a conscious decision that you're going to do it. But blindly accepting more risk to get the return you used to get in a high return world, it can be a big mistake.
In this context, how worried are you about the potential risk of inflation as a result of this low interest rate environment in the US and the actions of the Federal Reserve? How do you ensure that you still keep up with the purchasing power ability for your capital?
It's very difficult. A lot of our investing is in fixed income. Fixed income, by definition, doesn't adjust to inflation. If we buy 8% bonds today with inflation at 3 and inflation goes to 6, we still have an 8% bond. Our real return has gone down, period. There's no adjustability in fixed income. And that's one of the things we do, but just for an example. I'm personally not worried about a return to hyperinflation. Inflation is modest, could go higher. Everybody would like to see it go higher because usually higher inflation is associated with prosperity. And I'd like to see that. And governments around the world would like to see it so they can pay their debts with low value currency. I don't think we're going to have hyperinflation. And I always get in trouble when I stray into the macro, and I'm far from an economist. But, where does inflation come from? Well, demand pull comes from too much money chasing too few goods. I don't think we have that, or will anytime soon. The cost push comes from an escalation of the cost of the factors of production. For the most part, I don't see that, unless the Chinese crowd us all out in terms of buying currencies. Most of the possible sources of inflation, I think, would come from international considerations like that. The guy who works in China for 60 cents a day demanding $1.20 a day. It could happen, but I don't think it's going to be pervasive enough to pitch us into hyperinflation.
Risk control is Oaktree's first tenet in its investment philosophy. Here you make an important distinction between risk control and risk avoidance. Help us understand this distinction, perhaps by way of an example.
Well, the greatest example is this. If you went to the horse races, would you always bet on the favorite? The favorite, assuming the crowd is intelligent, which usually it is, the favorite is the horse with the highest probability of winning. That doesn't mean that the favorite is always the best bet. You might have another horse which has a lower probability of winning, but the odds so much higher that that's the smart bet. I mean, leaving alone anything specific that you know about the horses. But the point is, it's not just, this is the second level again. First level says, native dancer is going to win the race. It's always won, so we should bet on native dancer, even if the payoff is 6 to 5. You put up $5, and if it wins, you get 6. Maybe the better bet is Beetlebaum, which nobody expects to win, and consequently, it has a lower probability of winning. But if it wins, it'll pay 4-1. So it's the same thing. You have to make investments where the risk can be assessed, diversified, and where you're highly paid to do so. And so, the book, I think, is full of explanation of why so-called high quality investments are not always, and in fact maybe are rarely, the best bet. And that's what this distinction is all about. We want to make intelligent bets. We don't want to invest in high quality or safe things because a so-called safe thing at bad odds is a bad investment. And sometimes I think that the word quality should be banished from the investment business if you want to make money.
In today's environment, there is a lot of talk about U.S. Treasuries being a safe haven, and as it is turning out, it is proving true. Do you see that as an example of what we just talked about?
Well, I mean, U.S. Treasuries, I think Jim Grant called them certificates of confiscation, are a great example. They are a safe investment in the sense that the outcome is known and not really subject to variation. I think they're not a good investment because the known outcome is an unattractive one. I mean, today you can buy the 10-year and with no risk lock up the certainty of 1.9% return for 10 years. Well, is that really a good thing to lock up? Under what circumstances will that turn out to have been an attractive investment? And the answer is, in my opinion, deflation or depression. I don't think we're going to have those things, or anyway, we can't plan on having them. And so the range of outcomes under which that safe asset turns out to have been a smart investment is rather narrow. I was on a panel 2 days ago in Los Angeles with Jeremy Grantham, and he said, well, people talk about the risk-free return. Treasuries are the return-free risk. And I think he's got something there.
You talk about the importance of being attentive to cycles and the pendulum-like oscillation of investor attitudes and behavior. However, most value investors tend to ignore macroeconomic events and investor sentiment, often relying on a measure of normalized or through the cycle earnings and relying on their own convictions. How do you define being attentive, and how do we ensure we do not become too attentive?
Well, first of all your questions would start with the word how. It's very hard to answer them because there's no secret method for any of this stuff. You just have to be aware of concepts that's smart in their application, and it helps to be an old man so that you have the experience that helps, or an old woman even. If you're a value investor and you invest whenever you find a stock which is selling for a third less than your estimate of intrinsic value, and you say, I don't care about the macro, ignore the macro, ignore what I call the temperature of the market, then you're kind of acting as if the world is always the same, and the desirability of making investments is always the same. But the world changes radically, and sometimes the investing world is highly hospitable when prices are depressed, and sometimes it's very hostile when prices are elevated. And guess what you're saying is, well, we just look at the micro. We look at them one stock at a time. We buy them whenever they're cheap. I can't argue with that. On the other hand, it's much easier to make money when the world is depressed, because when it stops being depressed, it's like a compressed spring that comes back. So if you buy a cheap stock when the market is high, it's a challenge, because if market being high is followed by a general decline in prices, then for you to make money in your cheap stock, you have to swim against the tide. If you buy when the market is low, and that lowness is going to be corrected by a general inflation, and you buy your cheap stock, then you have the tailwind in your favor. So I think it's unrealistic and maybe hubristic to say, I don't care about what's going on in the world. I know a cheap stock when I see one. And if you don't follow the pendulum and understand the cycle, then that implies that you always invest as much money as aggressively. That doesn't make any sense to me. I've been around too long to think that that a good investment is always equally good all the time, regardless of the climate.
You say that the necessary condition for the existence of bargains is that perception has to be considerably worse than reality. Where do you think has perception potentially reached such a level? Is the Eurozone a potentially fruitful hunting ground for Oaktree?
Well, you keep using the word potential, which gives me a good out, because anything which has gone down in price a lot is potentially a source of opportunity. But the question is, has it declined sufficiently relative to reality? So if a stock was efficiently fairly priced 5 years ago at X, fair. Today the stock is down half. But in some sense, reality is also down half, then the stock is only fairly priced. Lower in price, but not cheaper. So it's the, what the investor has to do is weigh out, on the one hand, price, and on the other hand, reality. And so, look, everybody thinks very dire thoughts about Europe and the euro. And I would be the last person in the world to argue against that position. And then the next question is, okay, European assets are lower in price because of the conditions, macro conditions, but are the macro conditions being viewed too pessimistically? And the answer is, how do you know? Go back to second level thinking. Are you capable of thinking better, different and better about the fate of Europe? I don't think so. I don't think I can. I don't think anybody really has a good handle on what's going to happen in Europe. So then how can gaming the Europe situation give you an edge? You can't, if you don't have control over something, superior insight. I don't see control in the sense of being able to make it work. But if you don't have superior insight, then how can something be to your advantage? And we don't, one of the tenets of our philosophy, you named number 1, which is risk control. Number 5 is we don't bet on macro forecasts. And I think it's very hard to consistently be above average in correctness with regard to the macro.
You say that knowing what you don't know can give you a great advantage as an investor. Warren Buffett calls this the circle of competence. What is Oaktree's circle of competence? And more important, can you give us an example of what lies just outside that circle?
Well, we've been making credit-based investments. since I started Citibank's high yield bond fund. And we went from high yield and converts to international converts and European high yield to distressed debt, to distress for control, to distressed mortgages, to mezzanine finance. So a lot of what we've done, although not all, has been credit-based. We consider that, to use your term, certainly one of our greatest circles of competence. And we emphasize the things that have a high probability of paying off for us. I'll bet there are other people out there who are better than us at investing in things that have a low probability of paying off, but with a very high payoff. So our emphasis is on risk-controlled situations. That we're probably more competent in that than other things. I think maybe another example of something that may be outside our competence. We've never made an investment in a sovereign credit. I view sovereign debt investing as largely a political analysis rather than economic analysis. I don't know how to do it. But I'll bet that. I hope it can be done, and one of these days maybe we'll go out and find somebody who can do it, and maybe we'll add that competence to what we do. But we would be silly to bet on the bonds of peripheral Europe just because they've gone down. If we're not capable of superior second-level thinking, how would we know enough to outthink the person who's selling them to us and to have a high probability of a successful outcome?
In addition to corporate and distressed debt, a considerable amount of Oaktree's portfolio is in a category you define as control investing. Help us understand better how you approach distress for control situations and what you think makes Oaktree more successful here versus other funds.
When I was talking about competence, circles of competence, I think one of the elements on our side is that we've been doing it for a long time. We have a lot of experience in the things I've been discussing. And I think experience is very important. You have to learn the hard lessons. One thing I mentioned in one of my memos is that the human mind is very good at blotting out bad memories. Unfortunately, most important learning is from bad memories. So we have enough institutional memory to retain the lessons of the past. But we, in 1994, we organized our first distressed debt fund in 88, and then branched out into our first distress for control fund in 94. And, we figured that we could identify cases. Well, we did it because we spun that fund out because we had done it in the past. We invested in big chunks of the debt of smaller companies, so that when the debt was exchanged for equity, we ended up as the controlling shareholder. And so the question, is, number one, is this a company you'd like to control? And number two, is this a company where the creditors will get control? And then number three, which creditors? Because usually there's something called the fulcrum security, which is the first impaired class. The unimpaired will get their money. The first impaired class may get the company, and the lower impaired classes may get nothing. So it's the fulcrum. It's that one in the middle there. We try to identify that. We try to figure out if it'll get control and how much it will have to pay for control. And if it gets control at that price, will that be a successful investment? So it's a very interesting area. Of course, more moving parts to go wrong. and the investments are by definition less liquid, and you have I always say it's the difference between dating and getting married. When you're a distressed debt investor, you're dating, but when you try for distress for control, you get married, and you have to live with the consequences, for better or for worse, richer or poorer. But it can produce some good outcomes.
Listed equities are a rather small portion of Oaktree's overall portfolio. Are those investments a residual of that distress for control strategy, or do you also target equities particularly? How do you end up with equities in your portfolio?
No, we established a couple of strategies to invest in listed equities because we thought markets were inefficient or less efficient. The first example, the first case was in middle of 98 when we decided to go into emerging markets. So we formed an emerging markets long-short hedge fund that we have ever since. So, tenet number 3 of our investment philosophy says we're active in less efficient markets only. So, we probably wouldn't do a hedge fund for large cap New York Stock Exchange firms because, the tendencies are that those would be more efficient than others. But emerging markets, yes. Japan, yes. Didn't work out so well. The world's cheapest market has continued to get cheaper. So it's not a residual of some other activity. We never pass securities from one strategy or portfolio to another, but just a few markets where we've concluded that it was worth investing in equities, despite the fact that our main circle of competence is credit.
You make the distinction between playing defense and offense when investing. In other words, limiting risk and striving for return. Does Oaktree's ability to invest across the capital structure enable it to get the balance more right in terms of defense and offense versus other investors that may be more constrained?
I think that if you have flexibility in where you invest, it stands to reason that you should be able to make adjustments that enable you to reach your goals. Sometimes. This goes back to what we said before. You said, well, some value investors are willing to ignore the macro, and they say, if the stock's selling for a third less than the intrinsic value, I'm going to buy it. But the question is, do you want to be equally aggressive all the time? Or do you want to play offense sometimes and defense at others? And I would argue that you should adjust your activities based on the climate of the market. So that's what we do. And, sometimes in the distressed debt portfolio, we want to be at the very top of the capital structure. That may be because that's where the best bargains are. It may be because the macro environment is certain that we don't want to live with macro uncertainty. But at other times, when these things are cheaper, when the environment seems less treacherous, maybe we'll drop down into the second level on the balance sheet, or maybe the third. Historically, we don't go to the bottom of the stack very often. But again, I think that these adjustments are worth making. Is a great dilemma, because on the one hand, you want to stick to your circle of competence, to use your term, or Buffett's.
Well, Warren Buffett's term.
I guess I shouldn't attribute it to you.
Please.
But on the other hand, it's probably a mistake to say, I do this, I do this, I don't do that, I don't do that, because At the same time that you want to capitalize on your expertise, you want to be flexible enough to pursue the bargains where they are. And you don't want to be so dogmatic that you say, I only do this, which implies I do it whether it's cheap or not. So this is one of the great dilemmas. You asked earlier where inefficiencies come from. Largely, they come from people who say, I do this and I don't do that. What they're basically saying is, I don't do that regardless how cheap it is. Well, that's silly, because then you just leave bargains for others. And if you say, I do this, but I don't do that regardless how cheap it is, you're basically saying, I do this regardless how expensive it is. That doesn't make much sense either. So this is why I think you have to be realistic. You have to be sensitive to conditions in your world. And you should adjust your tactics, offense, defense, based on conditions in your environment.
Now, the title of the book is The Most Important Thing, but as your readers will know, all the concepts in the book are important, and leaving out even one of them will likely lead to not optimal performance. So if all of these concepts, and we've touched on a few, risk, the relationship between value and price, if they're all important to achieve superior performance, what is the single biggest mistake that you think keeps investors from reaching their goals?
First of all, while I think about that, let me mention that I think the 20 things listed in the book are all the most important thing. And then I thought of the 21st. So later on this spring, I think, we'll be coming out with a new electronic edition of the book called The Most Important Thing Illuminated, which will include comments on the content of the book from Seth Klarman and Joel Greenblatt and Paul Johnson and Chris Davis, in addition to myself, and a new 21st chapter, which says that the most important thing is realistic expectations, because I think that people tend to get in trouble in investing when they have unrealistic expectations, and especially when they have the expectation that higher returns can be earned without an increase in risk. That's a very dangerous expectation. Which is the thing which is most dangerous to omit? I think it's risk consciousness. I think that the great accomplishment in investing is not making a lot of money. It's making a lot of money with less than commensurate risk. And so you have to understand risk and be very conscious of it and control it and know it when you see it. And the great investors, the people that I think of great investors, are really characterized by exceptionally low levels of loss, infrequent loss, infrequency of bad years, and I think that's one of the reasons why we have to think of great investing in terms of a long time span. Short-term performance is an imposter. The investment business is full of people who got famous for being right once in a row. But if you read Taleb, if you read Fooled by Randomness, you understand that being right once proves nothing. You can be right once through nothing but luck. The law of large numbers says that if you have more results, you tend to drive out random error, and the sample mean tends to converge with the universe mean. In other words, the apparent reality tends to converge with the real underlying reality. And the great investors are the people who have made a lot of investments over a long period of time and made a lot of money, and their results show that it wasn't a fluke, that they did it consistently. And the way you do it consistently, in my opinion, is by being mindful of risk and limiting it.
Well, on that note, Howard, thank you very much for your time and all the insights you've shared with us in the book and here today.
Well, it was a great pleasure for me, and I appreciate your interest in the concepts.